This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the CEO of JPMorgan Chase now says that the worst case scenario is coming, and we're going to show you just how bad it's going to get. Plus, we're seeing further signs that China is likely to be the epicenter of the next global financial crisis. And at the same time, we're now getting new data from the U.S. consumer that is an ominous warning for the U.S. economy. And if you're wondering what we're doing in Texas today, well, there's a big problem there that says that there's big problems coming for the U.S. economy. Plus, we've got a sponsor for today's show. You may remember Soluna. Well, they're back with big news. They're the company that builds data centers to use up all that excess energy, and we're going to show you an incredible, simple chart setup that shows that their stock could go up by as much as 30%. You've got to check it out. They're on the NASDAQ under the symbol SLNH, or stay tuned to the end of the show, or check out the pinned comment or description for more information. Now let's head over to CNBC, where we picked today's story up with the headline, "Fixing China's Property Sector Could Take Years, if not a Decade." Now this is a huge problem here, because what you're going to see is that China has stemmed all of their economic growth on their real estate sector, and there's only so far you can go with this. And then the next problem we see is their banking system is entirely dependent on the growth of their real estate sector. So if their real estate sector goes, well, their banking system follows, and as you're about to see, there's new problems there, and it's getting worse. Fixing the property sector may be a multi-year or even decades work in front of us. Reason being, we built way too many housing for Chinese people. This from the chief economist of Grow Investment. Also, Chinese urbanization process, which has been progressing very fast in the past 10 years, is coming to a halt. So this is not something you want to hear that says, hey, we overbuilt, and well, we're seeing this urbanization grind to a halt, because what we know about their real estate developers is they are functional Ponzi schemes. They are taking money that they get in today to build the properties that people have already purchased. Without an incoming new flow of buyers, well, the money dries up. And if the banks can't lend, of course, as we're seeing, next thing you know, the whole thing just crashes in upon itself and gets really ugly really fast. Just over the weekend, a former Chinese official warned that China's population of 1.4 billion would not even be able to fill the unoccupied apartments across the country, suggesting that China has been using real estate to fund its growth, and that can't go on forever. There's now an oversupply of real estate. 1.4 billion people may not be able to live in them. And this is a big problem, as once people reset their expectation and maybe realize that there's so much supply, prices have to come down. And also the economy restructures to regrow from the other industries rather than relying mostly on the property sector, which has been for growth. They will actually have a better, much healthier Chinese economy than before. The problem is, before it gets to that point, you're going to see the Chinese economy come crashing down. The only question is, will it lead the rest of the countries? I think it will, and if it doesn't, well, it will be quickly to follow whoever goes down first, because here you can see another problem with the property developers. One of our Chinese Evergrande, their shares are down again for the second day after they missed their bond payment. Remember, we talked about how they had just restructured all of these bonds, and they were getting the investors to buy into it, and we knew why. It's a simple story. We don't have the money. So if you want a chance at getting paid, here's the scenario we're giving you. Extend the payments out. You do whatever we say, and there's a good chance we'll make the payments. And lo and behold, they missed it. Here we can see their shares stood for the second day as their main domestic unit said in a Shenzhen Stock Exchange filing late Monday that it failed to pay the principal and interest on a 4 billion yuan bond that was due by September 25th. Now, why does it matter that it's a yuan denominated bond and not a dollar bond? Well, it doesn't matter a whole lot, because what it tells us is it doesn't matter what it's denominated in. They don't have enough money. They don't have, in this case, enough yuan to pay the bond holders. They've got problems. And remember, we talked about this in the show the other day, that money was leaving China. People were trying to get their money out. The yuan was crashing. This was a huge issue. And lo and behold, another missed payment. The only question is, at what point do the dominoes just start to fall and all of the property developers go? Again, our base case, next financial crisis starts in China. But another problem here we see for the U.S. economy is crude oil, where this headline is oil can push higher as Cushing stockpiles collapse. Of course, what are we doing in Texas? We're looking for oil. They got a lot of it, but maybe they need to get some more, because crude prices will likely get a fresh boost this week as stockpiles at the key U.S. storage hub in Cushing, Oklahoma, risk collapsing to the lowest level in almost a decade. Such a move would embolden these aiming for a return of $100 oil by the year end. And here you can see why Cushing matters, and this is why we're in Texas looking for oil, because the delivery point for WTI futures, the rise and fall of the holdings is among the market's most closely followed trends. And so far in Q3, inventories have slumped by 47% to 22.9 million barrels. You can see on this chart here, it is at levels that are considered historical lows. And it's the lowest since July of 2022 and not far away from the 2014 lows. So that means we've got an oil shortage, not to mention we've got a yuan shortage and a dollar shortage. So what's going to happen with crude oil is everyone believes now the next move in the price is $100 a barrel. That is a big problem for the U.S. economy, because if you think about the fact that consumers are running out of money, we've talked about this before, and when they don't have enough and the energy prices go up, they've got to pay it. You've got to pay rent, you've got to pay food, and you've got to pay energy. Everything else comes after that. So if energy prices are going up too quickly and money is tight, what does that mean for the U.S. consumers? Is they have to cut their spending, their discretionary spending elsewhere. And sure enough, we see that on this chart here as we look at advanced retail sales, as shown in blue, on a year-over-year rate of change against crude oil prices, this being the West Texas Intermediate, that out of Cushing, Oklahoma. And here you can see as retail sales head lower, look at that, crude oil prices going up. So there's the energy effect. Consumers couldn't afford it, and sure enough, driving spending down. How about here we head into the global financial crisis? We remember crude oil prices just shot to the moon. Of course, now people are saying $100 a barrel. Maybe it goes higher, but look at this, advanced retail sales, year-over-year rate of change heading down. Again, a sign the U.S. consumer, money was tight. They couldn't afford those higher prices. They had to take their spending away from somewhere else. Again, you see it in 2018, crude oil prices take off. U.S. consumers say no way. And here we see it again. Everyone says crude's got to go up. Demand on the consumer side likely to head a whole lot lower. And that translates into our next story here with consumer sentiment, because as we get to this worst case scenario from JPMorgan, I want to set up the fact that the Chinese economy is about to blow up because of their property sector. Higher energy prices right now, bad timing for the U.S. economy. And now look how U.S. consumers are starting to react. As U.S. consumer confidence fell again in September, this from the Conference Board, as the expectations index, get this, declined for the second straight month, sinking back below a recession threshold. So there's two things we look at, is how consumers feel today and how they feel down the road. And if they're feeling optimistic about the future, what do they usually do? They spend money. And when they don't, what happens? They start to save, they cut spending, and start paying off their debt. And right now, that is not the recipe for the economy that we need. We need people to go out and spend in a big way. Here you can see it declined again in September to 103.0. Keep that in mind. In 1985, that was adjusted as 100, down from upwardly revised 108 in August. The present situation, based on consumers' assessment of current business and labor market conditions, rose slightly. So we see consumers are a little more optimistic about the current situation, but what we care about is the future. And the expectations index, based on consumers' short-term outlook for income, business, and labor market conditions, declined to 73.7 in September after falling to 83.3 in August. That tells us consumers thinking recession on the horizon here. Expectations below 80, a level that historically signals a recession in the next 12 months. If that isn't ominous enough, consumer fears of an impending recession also ticked back up, consistent with the short and shallow economic contraction we anticipate for the first half of 2024. I can tell you right now, if consumers stop spending, it's not going to be a slight contraction. It's going to be an all-out recession with the U.S. banks going down too. And here we can see consumers are their expectations for interest rates are declining. We note that as interest rates rise as well in the short term, making big ticket items even more expensive, but they still think rates are coming down. The outlook for stock prices continues to go down, and notably the 12-month average inflation expectations. Remember, Fed says this goes higher, have held steady over the past 3 months despite ongoing complaints about higher prices. Consumers not buying into what the Fed's view here, and still the measure of expected family financial situation. This is 6 months out, is worsened further, not exactly what we want to see, because when, again, and here's the key thing, when consumers are less optimistic, cut spending, pay off debt, and increase savings. Not what you need in a debt-based economy. You need the opposite. Borrow money and spend on stuff you don't need. That's how the economy works. But then if people stop spending, the next result is layoffs. And sure enough, we have here the University of Michigan Consumer Sentiment Survey. This in blue, and it's the 4-week moving average of initial claims. And we know that everyone says initial claims are coming way back down, and we've been saying not likely at all, as long as the U.S. consumer has a change of perspective. And now we're seeing it. This is, again, the University of Michigan data. So if the Conference Board is turning down, we'll expect this to follow. And notably, look back in history here. Anytime the consumer confidence survey goes down, what happens? 4-week moving average initial claims goes up. You see it here in the late 80s into the 1990s. You see it again during the dot-com bubble. You see it going the global financial crisis. Again, a consumer-led economy. When the consumer stops spending, that means we see unemployment go up. We're about to see that again, and that is a dangerous sign as we head into the holiday season. And keep in mind, this is a 6-month outlook, has gone down 2 months in a row. We should see that going up. That's what the politicians and the policymakers keep telling us. The U.S. consumer says we don't see it at all. The proportion of consumers saying recession is somewhat or very likely rose in September after dropping in August. The fluctuating soundings likely reflect ongoing uncertainty given mixed buying plans, and that's not what we need. We need consumers to spend, and spend some more. On a 6-month moving average basis, plans to purchase autos were flat but remained at elevated levels, while plans to purchase appliances continued to trend upward, but plans to buy homes, more in line with rising interest rates, continue to trend downward, even as today we saw that home prices headed higher. But now we've got our headline story. It's Jamie Dimon, the CEO of JPMorgan Chase, warned 7% Fed rate still possible. Now, why would he be calling for this? Well, there's a couple reasons we have to address here. The question is, does Jamie Dimon really believe rates are getting to 7%? My guess is he doesn't. What we've noted in the past, when he gets out and starts talking about higher rates, what he's also telling all of their hedge fund clients is short the bond market, short it some more, and when you hadn't had enough, go short it a third time, because what we've seen in the past is JPMorgan has taken the opposite end, the long bond trade and all of these, and it all stems around him going out and talking rates going higher. I'm going to show you why this is a bad case scenario, and then why I think he's actually completely wrong about the Fed getting to 7%. As markets may be predicting the end of the Federal Reserve's tightening cycle, but Jamie Dimon is still telling clients to prepare for a worst case scenario and benchmark interest rates hitting a whopping 7%, then that's not the issue we have. Is maybe they get to 7, and it's not likely, but along with stagflation. Now the question is, what is stagflation? It's a period of rising interest rates and rising inflation and rising unemployment. This is the 1970s and early 80s that everyone is worried about happening again. I'm going to show you why stagflation not likely to happen at all. That case is gone, and we'll show you why. We urge our clients to be prepared for that kind of stress. We should, as he said, Des, we should probably short the bond market a lot so we can take the long end of the trade against you. And here you can see the consumer price index in blue shown on a year-over-year rate of change against the 4-week moving average of initial claims. So you remember stagflation, rising interest rates. Here you go, early 1970s, rising unemployment. You see again, kind of late 70s here, rising inflation, rising unemployment. And then all of a sudden that starts to change here going into 1990. Now the question is, why isn't this happening again? Because when you look back at the 1970s, going into the 80s, the U.S. economy relative to the rest of the world was very closed. And now we're an open economy, global economy. So things are very different. And you see that progression now in the chart. Let's go back. Here you can see in 1990, And 4-week moving average, initial claims headed higher as people had the unemployment line, inflation pops, and then comes crashing down. So we see people on unemployment have less income, and that means less demand. Consumer prices come down. We see that here into the dot-com bubble. Now more in sync. We see rising unemployment claims, and then consumer price index comes down. You see it again in the global financial crisis. This time it takes a while for consumer prices to come down because of crude oil. And then we see it here again going into the pandemic. And now, once again, we see rising initial claims. Inflation comes down. That is why we are highly unlikely to see stagflation. What do you think? Do you think that is a possibility? Or do you think the new global economy says not a chance? If we have it, it doesn't last very long. His comments contrast with the consensus view after 5.25 percentage point hikes that lifted the benchmark rate to 5.5%, the highest in 22 years. But U.S. policymakers have signaled that rates will need to stay higher for longer to contain inflation. The money markets say you're completely wrong, Fed, and you will be cutting sooner than later. That's because these money curves, they know what they're talking about. Here you can see the yield curve. This one's now, it's a 10-year, 3-month Treasury security yield. That's where you take the 10-year Treasury security and subtract the 3-month. When it is negative or inverted here, as you see below the horizontal black line, that means these money curves are telling the Fed that you guys have got it completely wrong. You don't understand the monetary system, but we already know that. Looking back here into about 1989, the curve inverts, and lo and behold, Fed fund rates comes crumbling down. How about here? It's around 2001, Fed saying higher for longer, but longer wasn't much, and they started cutting. Here you can see around 2007, curve inverts, Fed's on that long stranding trend of higher for longer, but longer. Well, that didn't last again, and of course we know around late 2019, the curve inverts again, and what happens? Fed cuts. Now we've got it again. This time the Fed says higher for longer. The money curves say not a chance. But meanwhile, Diamond, who said rates may need to rise further to fight inflation, added the difference between 5 to 7% would be more painful to the economy than going from 3 to 5%. Look, the bottom line, Jamie, here is it doesn't matter how high rates going. All it matters is, are the curves inverted? We know you know this because you run a big bank. And when you do that, you understand that these inverted curves mean you don't lend as much. And that's the case we're making now. That's what matters in the economy. It's all about the creation of new money out of these commercial banks. Here you can see the net percentage of commercial banks tightening standards for firms of all sizes. That against the 10-year, 2-year yield curve shown in red. And notably, we see this chart over and over. We see the inversion or near inversion, 1998 to 2000. What happens? Banks say, you know what? We don't make money lending in this situation because we borrowed the short term, lend it the long term. When short term rates are higher, we lose money. So yes, we're tightening standards, giving out less loans. We see it here again around 2006, 2007. The yield curve starts to invert. Lo and behold, banks react just as they always do. And you see it again going into the pandemic. And then now you have it again. Look, Jamie, it doesn't matter if rates go to 7%. What matters is the curve inverted? Because just like any business would not sell a product at a loss, banks don't like to lend at a loss. Doesn't make any sense at all. That is the real problem. The world is certainly not prepared for a 7% federal funds rate, that's for sure. At that level, we would expect that we would have a deflationary asset unwind, and it would burst a lot of asset bubbles. It just simply wouldn't be sustainable. The reality is we're going to have that a whole lot sooner because we're running out of all that pandemic stimulus. Our base case is here, we're now a matter of months away, not from the worst case scenario Jamie Dimon thinks, but more along the lines of a recession and a financial crisis. But one place we do see opportunity is with our sponsor for today's show, Soluna. They're on the NASDAQ under the symbol SLNH. They've got a big update, and I'm going to show you a really simple chart setup there where we think their stock could go up as much as 30%. And here we have all their information in the pinned comment and description below. They sell every megawatt. That's what they do. And here you can see they have an update on their project. Dorothy 1 has reached full capacity. Here we see from John Blazer, the CEO. We've had a busy summer ramping up Project Dorothy through record high temperatures. As we approach the peak wind months and cooler temperatures in Texas, we've achieved a key milestone to complete Project Dorothy 1 and bring it to 50 megawatt capacity. We've also made great progress accelerating developments on Project Dorothy 2. Project Katie and working on operational improvements. And he said he was going to do this. I talked to him on the last time. He said, Steve, we're going to bring down our costs. Sure enough, including significant reductions in SG&A. And they've also been delivering on their promise to mitigate curtailment for renewable energy powered products. Let's take a big picture look at their stock price. We know it's on the MACD. They are oversold. We know it's on the RSI, sitting around 40, came off oversold territory. Momentum, just barely positive. And I want you to see this move here. There's been a lot of shares traded between 20 cents where it is now and 26 cents. This is a big deal. This is that potential 30% move. Let's take a look at some of their highlights real quick from their recent announcement. You can find it, of course, on their website. It's in all the links below. They've got their flagship fully ramped, and now Project Dorothy 1 has got that full 50 megawatts of capacity. They've got a platform for cash flow. That's important because they've also now achieved their first month of positive EBITDA. This is a fantastic news for them. And of course, their cash balance, they're expecting to end the quarter with a strong cash balance. We don't always see that with some of the companies on our show, but that is what Soluna is doing. And we absolutely love it because here, looking at this 90-day chart, we talk about supply zones. Here you can see this beautiful supply zone between roughly 18 cents and 20 cents a share. And you see anytime price gets down in this range, the buyers show up. Here it is. It dipped down here. Price rallied. It pulled back. And you can see right around 20 cents here when this is where the buyers are at. The sellers, where are they at? 26 cents. You can see once the accumulation is done down here in the supply zone, price usually rallies into the next. There's your 30% move on Soluna. As was always, when any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.